Hi, everybody. I'm Bonnie Helper. I write the weekly Startup One Stop newsletter and work with founders and help them with their pitch decks and introductions to investors where and when appropriate. And we host these breakfasts every 2 weeks online. Our investor insights. Michael Kocan is our guest this week. And first, I want to thank Joseph for hosting us. Joseph, you want to tell us a little bit about what you do?
Thanks, Bonnie.
I'll put the newsletter in the chat.
Thank you, Bonnie. Thanks, everyone, for joining. Joseph Katz. I am a startup marketing guy, so I've been helping startups go from unknown to well-known for a while, and mostly focused on early-stage companies, seed, Series A, some later stage. But if anyone needs help with their company, go-to-market strategy, building their business, I'm happy to discuss and help. That's me in a nutshell.
So, Michael, you can either have people introduce themselves so you know who's in the room, or you can tell us about yourself and your background in the fund and where your focus is. I know where your focus is. I think it's brilliant, but up to you.
Sure. Yeah, I'll start just giving a little bit of an overview of Outbound Capital and my background. And then, yeah, it'd be great to get to know the other folks in the room as well. So, yeah, to start with today, Outbound Capital is a seed-focused B2B software investment firm. So we're a VC firm. We started about 2.5 years ago with our first fund, Fund One, and now we're actually working on raising a second fund, Fund Two. My background is in electrical engineering. I graduated from Bucknell University back in 2004. And started working at the U.S. Department of Defense after that. So this was during the Iraq-Afghanistan invasions, and I was working with chem bio defense projects. So we were working on keeping our troops safe by detecting chemical, biological agents in the air and on the ground. So that was interesting, but I ultimately got a little bored of working for the government. The pace wasn't quite as fast as I would like it to have been. And I was always more interested in business and finance. So I decided to go back to get my MBA at Emory in Atlanta. Growing up in the Northeast, that was a little bit of a difference going down south for my MBA, but it was a pretty great experience at Emory. And this was during the financial crisis, like halfway through my program, and I was considering going into investment banking or management consulting, and ultimately ended up going into management consulting at that point. So I spent about 6 years with Accenture in their New York office and their strategy practice, consulting with Fortune 100 clients, all sorts of different industries. And kind of my big takeaway from that was many big companies have very similar problems. And so that's really been kind of a first principle at Outbound now is, we're trying to solve B2B problems. So problems that big businesses have with software solutions. And we like bigger kind of horizontal problems that affect many different industries. So the solutions to those problems would be like a Salesforce, for instance. Like anybody in any kind of industry could use Salesforce for their CRM. We like those kind of big horizontal problems because they have really big TAMs. However, when we do invest, we invest at seed, so we don't really expect our startups to be going to market horizontally like that. We expect them to pick an early adopter customer and go after them and really delight them. So interested in getting Joseph's insights on marketing or early on for seed stage startups for sure. But how I got into investing when I was living in Brooklyn at the time, and I had a really good friend from Bucknell who we've always talked about starting a company together, and we decided to start a small hedge fund, which is a kind of a funny thing to start. But my partner was very into stock trading, and he's the type of person that could have 6 monitors up with all the different stock charts and be happy staring at those all day. I was more on the operations side of the fund, and we did this on a part-time basis for about 4 years until we decided to quit our jobs in 2015 and go all in on the fund. So this fund was called Trend Discovery, and I really, when we quit our jobs to join our fund, which is like a startup fund at the time, I really wanted to get into startup investing. So I convinced my partner to carve out part of our fund and allow me to make some startup investments. And this was really like my fund zero, my first attempt at investing in startups. And it was, really kind of a blessing because I got to go out and invest in lots of random things and kind of understand like what I'm good at investing in, what I'm not as good at investing in. So invested in companies ranging from consumer technology to B2B SaaS to hardware, robotics. We even had a craft liquor brand based out of Brooklyn that we invested in. So we're kind of all over the place in that fund. And just the nature of the fund was a half hedge fund, half venture capital fund. So it was very hard to sell that fund to investors because it was very unclear, kind of, like what we were working on. We were both kind of just chasing our interests. So fast forward to 2019, we started kind of going in different directions, and we decided to merge that firm that we had built with another company, and my partner continued on in that direction, and I spun out to do Outbound Capital in 2020. So pretty much right before COVID, and kind of ideated Outbound Capital during COVID, and raised my first fund from individual investors in 2021 in the beginning of 2022. So we have about 32 LPs in our first fund, and many of whom are really new to investing in funds, investing in VC funds and investing in technology startups. So it's been a really cool experience to get 32 individuals kind of plugged into this tech ecosystem, who weren't necessarily as plugged in before. So that's been really rewarding. And I've also noticed that many of our individual investors, and just to give you an overview of their backgrounds, they're typically like executives at big corporations. They are management consulting partners at different famous strategy firms. They are Main Street entrepreneur type people, some tech entrepreneurs, but that's, pretty much the makeup of the individuals. And they really enjoy, when they can, kind of plugging in and helping our startup founders with their expertise. So that could be from helping make some customer introductions with their vast networks, having some advice on product, or giving some advice on go-to-market strategies and motions and pricing and that kind of stuff. So that's been really an interesting thing that I didn't expect from my investor base. And for Fund 2, what we've, and by the way, Fund 1 was a small fund. It's a $4.5 million fund. And we've made 12 investments out of that fund so far. And we'll likely make about 17 or 18 investments in that fund. But now we're working on Fund 2, which is a big step up from where we were. We're working on raising a $20 million fund. And again, we're raising that from individual investors, but also some bigger check writers like family offices and smaller institutions as well. So I kind of have a parallel path in terms of folks that I'm bringing into Fund 2. But I really wanted to lean into the individual side of the equation because in Fund 1, there was so much interest in kind of helping out our startups. And that really makes Outbound much bigger than what we are if we have, like 75 to 100 individuals who are willing to lend their expertise. And so we're actually building a product internally called Outbound Connect that is an efficient way to get, requests from founders and know exactly how to, ask our LP base if they want to help on that particular request. So going on for Fund 2, we're also focusing on helping our founders find product market fit faster. So we don't just make an investment and kind of walk away and hope for the best. We actually dig in quite a bit with our founders and co-founders on the how to find product market fit. We're not going in there and telling them what exactly to do, but it's really trying to help put some guardrails around the process, because it can be a very noisy time in an entrepreneur's life when they're trying to get from zero to their first million in revenue. They can go many different directions, and there's many different ways to find their customers, and their product can go in different directions. So we really try to help them with a process that we've developed, really a framework or an approach, along with some data models that we've developed to help them measure the outputs of their really their machine that they're building. And so we take a very measured approach to measuring the outputs of experiments in terms of like adoption metrics and retention metrics, and actually try to get pretty predictive of measuring some things that actually would predict adoption or predict retention. And then we use that to help our founders get insights to go in and make adjustments to their sales motion or their customer experience activities or even their product. So that's kind of the Outbound Capital in a nutshell. Sorry for taking a really long time there to tell everybody my background and Outbound Capital, but hopefully that was pretty clear. And yeah, happy to learn more about the folks on the call.
No, we love hearing about the background, and so we should hear from them. I have some questions. So I'm just going down my list. Mike.
Hi, how you doing today?
Good. How are you?
Good. It's been a long time, Bonnie. How's everything going?
Oh, everything's fine. Working with those startups on their pitch decks and introductions. So tell us how. I know what you're working on, but Michael and the rest of the room doesn't.
Yeah, for sure. So I have we have a company that where we've created an AI companion for children. It for young kids, and what it does is it helps them establish healthy habits, gives them the ABCs and 1, 2, 3s, and helps them with social emotional learning.
And what's the name of your company?
Horrible. Yeah, sorry. It's a look.
Okay, thank you. So are you raising your next round now, or where do you stand?
Yeah, we're in the middle of a capital raise. We have a seed round opened, and we have raised 4 million on 10. And we're looking to fill out the rest of the round. So we have 6 left in the round.
Oh, good for you. So Janice, tell us about yourself and what you're working on.
Well, hi, good morning, everyone. I am not in the tech space. I am the antidote to tech, but I make your tech space comfortable. So I'm a consumer product. That's my only link to this group. But I invented a head, neck, support, and back support system. So this is called Talcy, and so when you are on your computer all day long and you want some good head support, back support, right now I use it on my office chair for lumbar support, but is invented to go behind your head, support your head and neck while resting in an upright position or on an airplane. I invented it for my dad. We have our 1-year anniversary coming up. My founder story is to sleep in a geriatric chair, slumped over, and the pillows were not effective. And I tried to fix that, and I hugged him when he woke up because I was fussing so much. Pillows fell on the floor, and the floor was dirty. And I was like, what can strap to a chair? And so that's my invention. It's horizontal, which is back here, and vertical. And I'm in the business of bringing people comfort in uncomfortable situations.
Oh, okay. Michael invested in the craft beer. You never know.
Exactly. I just think, everybody who has a neck and a back is my audience. I'm currently raising, I'm doing a seed round right now, and with mine 500,000, and then my next raise after 18 months will be 2 million. I have, and I was going for the B2B. That was my business plan initially. I launched in March of 2020. So Michael, we have something in common. It was a bad time to go into hospitals and nursing homes. And so I had to spend about 18 months regrouping, packaging, all that stuff that direct to consumer people want. So
we have to keep it a little more brief, and thank you.
Right.
So Brian, tell us what you're working on.
Yeah, sorry if I can't have my camera on. So my name is Brian Pearson, Jr. I am the founder and CEO of EDU Rain. We built these official off-campus housing communities in partnership with colleges and their students, faculty, and staff, and we help 3 to 5 apartment buildings near that in that college's footprint be filled. And our platform specializes in targeting students being that first step of independence. And we have a program that helps them build credit, paying for rent off campus for free. We have 20,000 scholarships available for free from them. We have a roommate search. and we have a program that waives security deposit without sacrificing damage coverage to the landlord, and that apartment community pays to be a part of these off-campus housing sites that built these communities.
Oh, thank you. So, Sam, how's it going?
Going well. So I'm Sam Bogosh, CEO of Axle AI. We are a B2B software company, actually. We do software that uses AI to help content creation teams search and republish large amounts of video. So our customers range from corporate marketing departments like Kellogg's and Reebok, through to very high-end YouTubers. I'm visiting one today, and we have, broadcasters, political campaigns, sports teams. Basically, everybody is deluged with all this video content. So our software uses AI to categorize and tag the content, and then make it easy for the teams to make better use of their stuff. And we're at about a $1 million run rate, raised some money, 1.5 million to date, but at this point are actually trending towards cash flow positive, and are thinking about raising some money to grow faster this summer.
Oh, thank you. John, tell us what you're up to.
Good morning. Good to see you again. Thanks. So I'm with the company. We create custom private learning communities to commercialize learning science research and educational psychology funded by National Academy of Sciences and National Science Foundation. Had the first GSA contract for applied learning science. Did one of the clients that taught us the most was doing a project for U.S. Army intelligence, teaching Army intelligence officers how to read and speak Gulf dialects of Arabic in the context of military and cultural situations. And in doing that, was invited by the intelligence community to create a knowledge gathering tool that was online that allowed for iterative knowledge capture and processing and analysis for humans to use. And it's a online problem solving tool, and saw that had big applications to my corporate customers as well. So I began iteratively building and testing that. We're at Seed Plus. We're looking for a small, we're opening a small round, really just to help accelerate some of our tech stack development so that we can close more business. So we've got existing customers now, and yep, delighted to chat and listen. Look forward to learning more. Already serving a variety of markets now with real clients that are very near to making money.
Oh, thank you. So does anybody have a question?
I have a question.
Go ahead, Brian.
You said your first fund was like $6 million and you made like 20 investment, and you said your seed round. Like, what is the typical check size? And I'm guessing you guys aren't usually the lead investor then. Correct.
Yeah, great question, Brian. Yeah, first fund was 4.5 million. Second fund aiming for 20. Both in those situations, we would be what's considered a value-added follower at seed. Yeah, so we don't lead the seed rounds. Part of what I view kind of Outbound's world as three constituencies. We have our limited partner investors, we have the founders that we invest in, and then we have our broader VC co-investing community, which is a big part of what we do. Like part of my day-to-day is spending time and reaching out to creating relationships with other VCs. So yeah. So to kind of, not to give you too long-winded of an answer, Brian, but when we invest, we like to, there's like three things that we don't really compromise on. One is strong, what we call founder problem fit, right? Like you're the right founder to be solving this big problem at the right time. And that's a pretty big kind of category in general, but baked into that is this a really big market opportunity? Like how many years have you spent rolling around in this problem and really kind of understanding the nuances of it? And so those are kind of some of the areas that we double click on. We also look at, do you have the right team to solve this problem? At the end of the day, we invest primarily in software companies. We do have some hard tech investments, but going forward will be more software. So like you must have like a CTO, right? That's able to be the person who is developing the first version of your tech stack. We don't like to see a lot of outsourcing of those types of roles to other like third-party firms that can help you build your software. We like to see the founding team being able to do that internally. That sounds kind of obvious if you're building a software company, but you'd be surprised at how many founders I speak to that don't have those capabilities internally. And then finally, it's kind of like a mindset thing that we look at for founders in terms of we view going from like seed to Series A and to getting to that 1 million plus in ARR is really a series of experiments. And I've already heard a couple folks on the call talking about how they're getting towards those numbers, and I'm assuming that's probably has been their journey is a series of experiments to really understand who your early adopters are, how to create the second, third version of your product to really delight those early adopters, how to go to market effectively. You can test different go-to-market motions, like how to price your product effectively. We think this is all very experimental in nature and less about kind of hitting, talk about hitting revenue numbers, but it's less about hitting the revenue numbers. Like we think the revenue numbers will come automatically if you sort out the other things. If you're really, really strong on who your early adopter customer is and you're delighting them, the revenue will sort itself out. So we actually think that it takes quite a bit of runway to get from like a seed to a Series A. And obviously that's happening quite a bit in the market today, where most of our companies who have raised a seed in the past couple rounds or a couple years are raising a seed extension. They're trying to get to product market fit and get their numbers up. What I mean by that is their customers, their users, and their ARR. And so there's a lot to be done between their seed round and your Series A. And we think founders should really consider having about 36 months of runway to do all of that. If you want to run like an effective experiment to figure out who your early adopters are, we really think that's a 6 month process. And the same for other types of experiments. So yeah, what does that mean? That means that we invest typically at seed. I kind of view everything pre-Series A as also like pre-product market fit and all kind of the same thing, to be honest. We don't want to invest. We invest after there's a product. So before product, that's I consider that more pre-seed. We don't do a lot of that. Like to me, I prefer to invest after there's already a product, and then we can help our founders figure out who their early adopter customers are better because they have a product to actually go out into the market. We don't really want to underwrite the development of the first product, and frankly, we don't think it takes a lot of capital to create a first product in software today. So we think that that's something that should be able to kind of happen organically or with angels or accelerators, and those kind of funding sources. So when we invest at seed, we're either finding a startup that we want to invest in their seed round, but we're not going to be the lead. And usually at a seed round, they're raising about $2 to $5 million in capital, I would say. And usually there's a lead VC firm who's writing a check from like 1.5 to 2.5 million into those rounds. And then there's several other firms that come in and other angels and stuff like that as well into these seed rounds. So we're usually the check, to answer your question now, the check size that we write is about, on the first fund, it's about an average of 250,000. And then in the second fund, it will be between 300 and 500,000. So in both funds, we're going to be a follower in the seed round. The other lead firm will be setting the terms. The reason that everybody wants Outbound at the table is because we do a lot of work with the founders after we make the investment. So it's important for the co-investors that we're at the table, and the founders want us in the round because they know we can be helpful from a product market fit perspective. So we're usually pretty good at being able to get into the rounds we want to get into. And we're not very competitive with other VC firms. Like, we're not competing with another firm to lead the round. There can only be one lead. So in a deal where that's competitive, there might be like 10 seed firms trying to vie to be the lead, and only one will be the lead. So we like this positioning because it helps us get into the deals that we want to get into. And then what we do is, after we make the investment, we actually do a lot of work on product market fit. And frankly, we get a lot of data as to like how things are going, right? Like, so 6 to 12 months after we make the investment, we're either much more or less convicted on our investment, frankly. We're very convicted when we make the investment, but it's pretty amazing how that conviction level can change even in the first 6 to 12 months based on the execution ability of the founders and the experiments that they run. And so the ones that are doing really well and on the right track, we actually want to inject more capital into those startups to really be like the de facto seed extension lead. That really helps us get our ownership up. It helps extend the runway for those founders to get through all the experiments that we think they need to get through, and to get their ARR up to where it needs to be to have a competitive Series A round. And we want to be really the source of funding for that. So that's that strategy is our strategy going forward for Fund 2. It really wouldn't have been an effective strategy a couple of years ago. Like in 2021, when people were, there's so much capital in the ecosystem, there wasn't the need for these extension rounds. Even before you had found product market fit, you could raise a big Series A round, even maybe a B or a C round before you have product market fit. But today we don't see that happening. We think there's a lot more focus on value and getting to product market fit and showing that you have a repeatable sales motion before those bigger rounds of capital are available for you. So yeah, long-winded answer to your question there, Brian, but I hope that was helpful.
Oh, I have a question. So if they're stumbling on product market fit, how open or how often do you get them to sort of pivot? We know that all startups pivot. So is it usually a case of having them pivot? If they're open to it?
It's really interesting. The more we dig into the process that founders go through and should go through, the more like I'm trying to get specific around like what the words like pivot even means, right? Like what is a pivot, right? It's like, to me, I think it's a fundamental shift in like your machinery, right? Like we look at like the early stage company as like a machine, and one part is your product. How are you developing your product and the product features, etc. That's your dev team and your product lead. And then you have like a sales part of your machine, and then you have like a customer success part of your machine, right? Like after somebody actually starts using your product, you have to make sure they continue to get the value out of it. So I kind of define a pivot as any massive change to those sets of activities that you fundamentally do on a day-to-day basis. And yeah, I absolutely agree, Bonnie, that most startups do go through many pivots between the insight and between getting to product market fit, 100 for sure. And what we like to try to do is help our startups collect the right, or create a controlled experiment where they can change a particular input into their machinery. So whether it's like, who are the types of prospect customers you're going after? What are the product features that your customers are using? Like, what's your go-to-market motion? What's the pricing? And then the outputs of that you can actually measure, and that gives you some, and then you can dig in and get some insights. And so the pivots have to be based upon the insights that you're getting. And yeah, so going back to my other point, that's why we think like 36 months is the appropriate amount of time, because you have to go through all these cycles of these experiment cycles. It's very unlikely that you're going to like have an insight, unless you're maybe a third-time founder who just absolutely knows for sure, kind of like exactly what they're doing. It's just gonna take time to go through the cycles to make the pivots to your machinery and get to a place of relative stability.
And yet most investors recommend an 18-month runway.
Yeah, absolutely. We're definitely on the other side of that equation.
And from the marketing side, I can guarantee it's going to take longer than anyone thinks it will.
Yes.
Yeah.
And cost more than you think that you plan. So we have a latecomer. Tom, do you want to introduce yourself?
Sure, apologies. I was in my previous meetings. I'm Tom Ekwa. I'm a data scientist. I actually started in medicine. Then I moved to AI. I did a postdoc at Brigham and Women's and Harvard Medical School. I co-founded the company in the insurance industry. And last year we got acquired by a larger company, and now I am working on new opportunities, mostly in the AI and large language models space for medicine.
Ah, thank you. So next question. Didn't mean to monopolize it. Sam, you always have a question.
I do actually.
I knew that.
Yeah, thanks. I'll turn my camera back on. So one question is, we've been challenged in terms of the venture space. We've had some accelerator funding and done some equity crowdfunding, but our business model is not a pure SaaS model. And actually that's been largely driven because our company's been bootstrapped. So, SaaS is good when you have the luxury of kind of a 36-month runway in the bank, but we've actually never had that. And so we've had to kind of eat what we kill. So even to this day, like the majority of our revenue is non-recurring. We have a growing percentage that's recurring. But if we were to switch to all SaaS tomorrow, we'd be out of business 30 days later. So what we're trying to do is figure out how to transition to more of a venture funding sustainable model, even as we grow with the model that we have. Is that a situation that you're familiar with or you've seen out there?
Yeah, absolutely. Yeah, I'll just unpack that a little bit because I think that's actually a very common thing that I run into with folks. And actually, like so if your revenue is like not recurring, you're saying is that more like service revenue?
No,
like
it's perpetual license sales. So we sell, basically it's a razor and blade model. We sell the core software, and then the SaaS revenue comes from the AI services that are layered on top of that.
Okay. Yeah, so yeah, just a couple things on like the 36-month runway thing, your comment on that. I don't necessarily correlate runway with cash in the bank. Like this is maybe a counterintuitive thing as well. Like I think if like you're going to be spending your life dedicating yourself to some project, like, I mean, frankly, like I make very little running Outbound Capital, right? I make literally a fraction of what I used to make as a strategy consultant. Like when I get to fund 3, maybe I'll be back up there, so like, just raising a bunch of money so you can pay yourself a nice salary is like, I don't buy into that. Like you're either in it to win it, and like you're eating dirt for 3 years, like that's kind of like, that sounds maybe a bit aggressive, but frankly, it's the way I think about it. So I don't really think, I don't really correlate the runway with capital. Like I do think that if you raise money, it should be for a very specific reason. Like you're specifically testing a thing that requires money to test, and you literally can't do it any other way. That's also why I say like the founding team is really important. Like I don't want you to be paying a software vendor to like make your software. Like like you're a software company. If something needs to be changed, you spend the weekend making the change, and then like you're ready for Monday. You don't go and like do a change order and like spend a ton of money. Like, so that's just like, we just don't touch that stuff in general. So that's my comment on 36-month runway. But So I'll give you an example that's maybe not entirely related because it was more based on service revenue. We recently invested in a company that has done now multiple pivots to get to what is a sustainable SaaS model. And during that period, they bootstrapped and raised some capital from like a pre-seed perspective, both from like funds and like angel investors. Excuse me. And then they had a seed round of financing, which we participated in. So again, that's kind of like where we slot into this thing, to this process, you know. So they've already gone through pivots like before we even make us kind of a seed investment. So I think there's lots of pivots that happen even before you get to kind of like where you'd raise a real seed round. And then within the seed round, I think you make pivots too, but I think the pivots are less dramatic. So this company, just by anecdotally, they started their product as really a training course. So this is in the world of the modern data stack. Okay, so the modern data stack is a way to take all your data sources, ingest the data into a place, which is usually like a data warehouse, like think of Snowflake, and then you have to like build something on top of Snowflake so everything makes sense from like the data model perspective, and then you can run like business intelligence and get insights and stuff out of your data. So a lot of companies do not have a modern data stack in general. Big companies have their own data stacks that they built from scratch. A lot of like newer companies and mid-sized companies are adopting a modern data stack, but it's a lot of effort to build out this data stack because there's different vendors. You have to make negotiations. You have to connect everything together. It takes time and effort. But however, the effort's well worth it because the insights you can get from your data is really important to feed into your machinery. So they started as actually a training course to like train people, because this is a problem. It's like, how do you build a modern data stack? Like founders don't know, right? So they actually started building a training course. They built out this training program, and then they went and they tried to sell it, and they realized that they weren't able to sell it because nobody wants to be trained about how to do it. They just want someone to do it for them. So that was the first insight that led to a pivot. That pivot was, okay, why don't we hire a team in? They're actually headquartered in Asia, in Indonesia, and their engineering teams in Indonesia and Bangalore, but they go to market in the United States and Europe. So they built a team in Bangalore and Indonesia then they trained that team with their training program that they had made previously. So it wasn't like all wasted effort, right? And then they trained these people to actually then be the people who could then go in and do the service for a company who is trying to solve a problem, right? Which is how do you build a modern data stack? Then they realized, like kind of maybe where you're at now, okay, we can't actually attract venture capital based on this model. This is a service model. It's not a scalable product model or SaaS model. So then they had to blow up their service business and create and productize it, right? And so they made a product, which is a recurring revenue, and they made the business model around the product to be a recurring revenue model. So they're currently in the process of either firing their old clients or getting their old clients to get onto the platform. But they were at like 1 million ARR. Now they're back down to like 350K ARR, or not even ARR, sorry, over 1 million in revenue. Now down to like 300K in ARR. And so, but it's painful. You literally have to like kill the golden goose, potentially, if you want to go down this road. And now what they've done is actually they're spinning out their service business, and part of their platform is going to be like any service, like there could be any service consulting firm that's also kind of part of the platform that provides, like integration expertise and stuff like that. And they'll just be one of those vendors. So they're able to kind of continue integrating all the previous things that they did, but go through all these painful pivots along the way to get to something that's very scalable. Hopefully that's helpful.
Yeah. No, thanks.
Anybody else have a question?
Along these lines, length of runway and using tools, etc. I sort of like also like experiencing it myself, that there is some tension between doing things in a scrappy and efficient manner versus using the platform and tools that like everybody else is using, and focusing on spending the money to get growth rather than spending it efficiently. Where do you, and considering that there have been, like large macroeconomic changes, changes in the past 2 years, where do you think is the zeitgeist, or like sort of like preferences of venture capitals about like these choices?
Well, I don't really know. I don't know about other VC firms. So we're pretty much like Outbound kind of does its own thing based on first principles. So I don't, we're not, we have strong relationships with other VC firms, but I couldn't tell you like the zeitgeist, if you will. I would just say like growth. I don't even use the word growth, because like the companies that we deal with are companies that are raising their seed round of capital. They're trying to get to product market fit. There is no growth. Like you can't grow on something that you do not have product market fit. Like if you're growing something, if you're just like creating revenue, like you're not, like that's not a sustainable model, right? You need to get to product market fit first, and then you can start having those growth conversations. So I think like that's just the way we look at it. I don't, like I said, I don't even use the word growth because it's not relevant until it is relevant. And I think that you've seen a lot of situations in 2021, 22, or 2020 through 2022, where a bunch of companies raised a ton of capital on very weak product market fit, and with the expectation that you could grow, and they're not growing. They're just lighting money on fire. And now they're in a very bad situation where they've raised way more capital than even their worth, right? So if you raise more capital than your worth, like the way just the inside baseball and venture capitalists have a preference in the stack, right, in the capital stack. So they get their money out at least 1x before the common shares get anything. So there's a ton of startups out there that are completely underwater from a common stock perspective, and that's that I don't think that we've seen the fallout from that yet, but I would tell you the root cause of that is the fact that those startups did not have product market fit.
Makes sense.
Next question, feel free to just chime in.
I have a question actually. How do you view we have an opportunity right now where there is a party that wants to create a licensing opportunity in a new market that we didn't plan on originally releasing for our first go-to market. So it's in China, and she wants to create a joint venture, but also launch probably 3 to 4 years earlier in that market, and fund the activity. So she's looking to put up $3 to $5 million in order to fund the activity for a first go-to market. Do you view that as a risk, or do you view that as an opportunity?
Great question. I have no idea because I'm not close enough to your business, so I definitely can't give you advice on that. Nor am I like in your space in general. Yeah. So I think like again, I'd go back to first principles on this one, and it's like, what are you trying to achieve, right? And you should be doing everything you can to achieve whatever you're trying to achieve. If part of your near-term objectives is international expansion in China, then yeah, you should go after it. But if it's not, and it's just kind of a random thing, like I would probably just ignore it.
Yeah, it's the challenge because we're in the middle of this fundraise. We're undercapitalized still, right, in order to achieve the certain goals that we're looking to get to. And I see this as a mechanism to get access to non-dilutive capital in order to establish some of the activities that we're looking to do for the US base. But it does create a distraction. It's like all of a sudden now we're doing two things. You know what I mean?
Yeah,
I'll just jump in real quick because I've seen this in other businesses. It's the shiny object syndrome, I like to call it. You're getting distracted by something that is potentially going to take you off your course.
Yeah.
Yeah, I agree with Joseph on that one, for sure. I do think there's shiny objects that pop up all the time and tend to derail teams. I would try to figure out why you're undercapitalized, right? are you undercapitalized because investors just, I mean, do you have, like, you know what I mean? Like,
Well, we
do you
had,
have product market fit? You know, are
Oh, yeah,
customers
we
like
sold-
pulling product out of your hands at this point?
Well, we haven't shipped to market yet. We are in we're like in a seed plus scenario. So what had happened to us was we had in our seed round, during our angel round, we had a private equity group that came in and picked up the entire seed round at a $10 million at a 30 million pre. And that was at the end of 2021, 2022. And what had happened was that they're primarily a commercial real estate fund. So during this year, they just got destroyed, right? So they only were able to commit to the first million on the 10. So then we went back out to market and raised another, 2.5 million, right? Well, we just 3 million now, so we just pulled another 500. But it's moving really slowly, obviously, because of the situation that we're in and everything else. So what I'm trying to figure out now is there another way to access capital, right, to kind of complete to our mission in terms of being able to release. We do have strong indications of product market fit. We sold $200,000 worth of product in 20 days on our first go-to from a crowdfunding, like pre-sales, if I can say that, pre-sales. And we've been testing with families, and that's been going fantastic. So I don't feel like there's any strong issues. There's strong usage metrics and strong strong indications that the families like and want the product at the price point. So we don't have any major issues outside of capital. But just because I think of the state that we're in and how we dealt with that previous financer, we've been navigating and trying to figure out how to fill out the rest of the round, basically, right?
So just to be clear, you're capital intensive because you're fundamentally building a product, like a physical thing. Is that why it took you so much money?
Yeah, it's an AI robot. Like, it's basically,
got it.
And it's actually, it's the only one that works on device and et cetera, et cetera. So there's a lot of IP that's been created as part of that.
Yeah, gotcha. Yeah, this is why I don't invest, but not why, but this is like, it's just consumer products definitely is not my wheelhouse. Mainly because there's just so it costs a lot of money to do what you're trying to do. And so you get in a situation where you have to raise a ton of money. And frankly, we do have some hard tech investments we've made. Like, I can just give you an anecdote. We have a vertical takeoff and landing aircraft company that frankly has burnt about as much money as you have already. And, to get to like a subscale prototype of an actual airplane. However, to get to a full-scale prototype of an airplane, it takes $50 million, right? It just does. Like, that's as efficient as they possibly can be. And right now they are going to where the money is. I mean, it is not as available as it was in 2021. It sounds like you definitely hit the market right on that in 2021 to get that real estate firm to invest in your business, because they were probably looking to diversify, and they had money just rolling in. Today's an entirely different world. Even this company that's like a game-changing regional transportation option. I mean, they're spending time in Dubai, Saudi Arabia, Qatar. They're going to where the money and the people that want to do the innovation are. That's how they're doing it. I would try to figure out where those pools of capital are for you, because you're going to need big pools of capital. Potentially consider partnerships with other bigger, toy companies or tech toy type situations, or learning companies who would want to make a strategic investment. That could be a potential option too.
No, I appreciate that. Yeah, Michael, that's part of the reason why I came to this, just specifically because I can ask questions, knowing that you're not an investor in our space, right? It makes it much easier, right? Because I can just be frank, Yeah,
no, that's great.
Brian has a question that he posted in the chat. Do you want to give us your question, Brian, or do you want to know how many founders of color or women have you invested in?
Yeah, I don't actually keep statistics, but we have two Black founders. Well, one is Black founder and has a woman co-founder. Very like many, I would say less women than people of color. In terms of DEI, I just think it's a natural thing that makes sense. Like we want to invest, and we want to have LPs and people who advise us who are diverse, and that's for the strategic reason that we'll be smarter and better investors because of that. In terms of the founders we look to invest in, we actually kind of heavily lean towards immigrant founders. And this gets pretty deep into my general feeling of human motivation. But I've found that folks that are first or second generation immigrants generally have a run through walls mentality to get it done. And I would say that like maybe third, fourth, fifth generation Americans may have lost a little bit of that along the way. That doesn't mean we don't invest in Americans. However, we do have many immigrants that we invest in, and they sometimes end up being people of color or women.
It's funny because the question I was going to ask is, we know that investors say that they invest in the team, where, the founder, which boils down to the founder, that when you're pitching, you're really the product. I was going to say, is there anything in specific you look for, aside from being immigrants? What's that je ne sais quoi that makes you write that check?
Yeah, absolutely. I mean, I do a lot of thinking about this. Frankly, I think it's the most interesting part of the job and why I get really excited about doing this. Well, first of all, I would say they're not average people. I don't think average people can kind of do what you need to do to go from an insight to like $1 billion company. I think just by definition that's true. So there has to be like some characteristics that are differentiating. The big things we look for is like what I just tried to describe, in being an immigrant is kind of a proxy for it, but it's basically this concept of like a chip on your shoulder and just willing to do what is necessary to get the job done. And a different way to describe that is it's like your motive force as a person. And I think that people who have a big distance between like where they are and where they want to be have a big motive force behind them and what they're trying to do. And so I look for that distance, and that could even be like an Elon Musk, right? There's a big distance between where he is and where he wants to be, even though he's one of the richest people in the world. That's one thing. So that's a very primary thing. The other thing that we look for is people who have they've spent a lot of time on this problem. So I focus much more on like the problem that's being solved than more so the solution to the problem. And again, we focus more on B2B stuff. So we only invest in like painkillers. We're not investing in like nice to have things. Like we want to get to the point of like really getting down to like ROI for the customer. So the customer needs to be delighted, and there has to be like a big financial reason why they're going to adopt your product, right? Especially today, when the buyers have transitioned from any random employee at a company can put in their credit card and use and buy a product, to now it's like a CFO level discussion about whether or not you're going to adopt a new technology. Budgets have just tightened up a lot. So we're looking for founders who have spent tons of time in the problem. So that kind of, if you just are, like I think crypto and Web3 was like an interesting case study in this of like the opposite. And so it was a bunch of folks who were like, okay, we have this new technology, blockchain, let's create solutions. But like, were they really solutions to a problem? And I think there's absolutely going to be big blockchain breakthroughs in the future, but they're going to be solving problems that can only be solved through blockchain. I don't think they're going to be the problems that currently exist today. So yeah, that's another big thing. It's just like how much time have these entrepreneurs like spent wrestling with these problems? Those are really frankly the two big things on the entrepreneur front. And then obviously it's there's intelligence and your skill set with new technology and what new technology you plan on bringing to the table is that like technology that you created? Like, is it your differentiating factor, or is it you're just using something off the shelf? Like what I'm seeing in AI today is just like everybody's building some little thing on top of open source large language model or over open AI. It's like you're not doing anything defensible in that regard. You're just using something. Like the interesting thing is what somebody else has created, and you're just kind of putting something on top of that. So if you have, really talking about AI for a second, if you have like really unique and good data sources that you could build some semantic layer over AI, I think you could definitely build an interesting company. But if you're just a startup that doesn't have those access to data, and you're just building something just on top of a model, like I don't think you're really building something defensible. So my point is like having a bunch of experience in the problem helps you understand like where your defensible angles could be. Hopefully that's hopefully that's a good answer.
Yes.
Michael, actually,
I have a chicken and egg question for you, Michael. So 20 odd years doing applied learning science, and when people you tell people that, their eyes kind of roll. So, well, I helped Microsoft and NASA and a broad variety of folks solve learning as a strategy problems. And when you boil it down, the biggest problem is how do you get people to have guided conversations around problems and then iteratively solve those in a meaningful way for business challenges. And we do that within these private online communities. We used to build these with my prior company as boutique solutions, and $500,000 for a solution just started a motor. And these were very expensive deals. And so I've been working the last 10 years on how to make those things cheap and easy and affordable for anyone to use, not just the big companies. And so my chicken and egg question is, when we speak to venture folks, because we're not looking for huge money, because I've bootstrapped and then got small angel and seed rounds to get us into the market and learn a lot in the last 6 years since we began licensing this to paying customers. When speaking to folks like you and other folks in the venture world, is it better for you to lead with the customer stories and help and say, this is how our customers are using this now? They're not making huge money yet because our model is subscription incremental. Or is it better to say, here's the big vision and here's what 23 years of experience in this space taught me and my team?
I mean, I think it's all of those things. I think like, initially as an investor, like that's interesting to me that you have so much experience in this space, which means that you understand some nuance to the problem that you're trying to solve, right? Which is unique, probably, right? There's probably like not another, 100 Johns out there that are.
No one has the background, the diversity that I do with projects all over the world.
Yeah. So, I mean, I think that, yeah, leading with that is good. So the thing that we work with our founders on, and you'd be surprised at how complicated this conversation gets.
Yes.
Well, we ask the simple question of how do you create value for your customers, and how do you know that you're creating value for your customers? That's pretty much it. Like if I had to just have one conversation with all my founders or any startup ever, like that's what I would do. Like that's the conversation I would have. And that's what it all comes down to. Like you're literally trying to create a solution to a problem. So that means that you're creating some sort of value in the universe for that user that's feeling pain. Like how do you articulate that? It's frankly, like I've never had anybody just like fire off the answer ever, in talking to thousands of companies. It's not as clear. It's like, it might be clear in the back of your recesses of your mind, but getting really clear about that, I think is really important. And then also how you would like actually measure that. And like, I can give you like another quick anecdote, maybe it's helpful. Another company that we invested in is in the data privacy space. They started so like everybody knows data privacy is an issue. In Europe, they care. In the United States, we don't care. We say we care, but we don't. It's like climate. We don't. Like it's not a top 2 voting issue. Yep. So they're actually based out of Ireland because they're in Europe where people care. and they created a solution that helps companies be compliant, and with data privacy. And the issue is like people can come on your website, whatever, you could be any company. People come and use whatever your product service, they come from everywhere, and they have different laws that apply to them based on where they come from. So there's not been a solution, there's a few attempts at solutions for this to help you be compliant. What they've learned is their compliance solution, when they took that, so this is an example of a pivot, they took their compliance solution to market, and they found that people were like, yeah, I really would like to be compliant to avoid fees in the future if somebody asks me to access their data that I have on them. And also I have no way of knowing the data I have on people because I've not done this before. They basically realized that people weren't willing to pay like what they thought, right? And the reason people aren't willing to pay is because the fines aren't big enough. Like there's not there's not enough of an incentive to actually get compliant, even in Europe. In the United States, like forget about it. So it's like, okay, their entire fundamental insight that companies need to be compliant because there's these big waves of data privacy is actually like incorrect, because the customers didn't get that value out of it. Even though they did get value out of it, they didn't get enough value out of it. So what they had to do is they had to pivot to being a consent solution. And so they again are extremely experimental in nature, and they realized like, okay, where's the biggest pain point for this? Frankly, it's in e-commerce and in companies that have global e-commerce channels, right? So people can come to your website from anywhere. And when they do come from anywhere, they have different data privacy that kind of that's associated with them. Like if you hit my website from Ireland, it's going to be different. I have to serve up something different from GDPR perspective than if you hit my website from Nebraska, right? So they actually created a consent product, which is at checkout. So they basically are now focusing on global e-commerce brands. They have a product that's consent oriented. So and the reason that this matters is because they determined like the big problem they're trying to solve for these e-commerce shops is how do those companies get more revenue? And they've had some challenges with like Apple's data privacy changes to their platform, making it harder for their marketing spend to result in increased revenue. So one of their challenges is like, how do we get more people that we can market to? Like you know what I mean? So if a user comes through an e-commerce shop, you have to determine if you're marketable or not, right? Can they send you an email? So with being really clear and trying to develop trust on the consent front from a data privacy perspective, they were able to increase the marketable rate of the users that go through websites from like in Europe, like the low 20s, 30s to like the high 70s, which is like a massive increase in the amount of people that those shops can market to and then increase their revenue. So it becomes like an absolute no-brainer decision to use their product because they're creating a ton of revenue. They even take it a step further after we've worked with them to actually try to turn that into dollars on a monthly basis. It's like, how much extra money are you making because you can market to all these people? And then comparing that number to what they pay for their product, it's a huge difference. So their churn is almost zero now. Where when they just had the compliance solution, it was a big difference. Or there was more churn. They're also going to market in the US. In the US, there's a lot of like people just market to you no matter what. I mean, I have there's a few shops that like I've tried to opt out like 30 times. I'm still getting emails from them. It's like, what's going on? Like they just, it's crazy. It's like the Wild West of the United States when it comes to data privacy, but they can still help increase the marketable rates in the US too, and make sure you're actually marketing compliantly. So they didn't like lose that heritage of compliance. They just pivoted their solution in a different way to deliver like real value, and eventually, they also are compliant, right? So they're still delivering the original value too. So that's just like an anecdotal story of sometimes how you have to go through different pivots and iterations to understand like how do you then explain the value that you're creating to your customers, and if you can do that coherently, I mean, I think that helps from like a getting investors on board perspective. And it obviously helps with increasing, your sales to new customers, as well as, continuing to sell to your old customers.
And getting clients is not a problem for us at all. I mean, we have to turn down clients because we don't have the capacity to really serve them all. And so on the investor side, it's, well, how is that so? Because they don't have necessarily the depth of knowledge on how these organizations actually work when it comes to knowledge as a strategy or knowledge as an asset within an organization. So we have to do a fair bit of unlearning to say this is the way people actually generate and use knowledge inside companies. And that's a concept that a lot of investment folks just don't grasp. So we do have to do a lot of unlearning.
Why do you have to turn away? Why do you have to turn away customers?
Because the volume of demand outstrips our current level of resources. We do as our high
Is there
touch
any way
is
you
only
can?
in the
Is there any way you can get those customers to prepay a little bit? That way you can fund more resources in order to, I mean, you have a good problem is my point.
Oh, absolutely.
Like,
it is. Yes.
I don't know if you necessarily want to be like giving away more of your company right now, right? Like, is there a more creative way? Is there a more creative way to finance this? Especially if you're just like knocking on doors and have a bunch of deaf ears. Is there a more creative way to finance this? There's also, not to go super far down this road, but there are like revenue-based financing opportunities that if you are bringing in decent revenue and you're able to take some of that and play towards some debt service, you could certainly do some revenue-based financing debt if that's truly the equation,
Sure,
and grow non-dilutively.
We have no debt. We have no debt, virtually no debt. We're looking at doing our C plus as a convertible note, and
what is the pushback you're getting from investors? Is it that they don't understand what it is that the value is that you're producing, or is it that they are worried about the market side?
I think it's probably a little bit of both, but I think we're also probably fishing in the wrong ponds because it's really been word of mouth that, I've bootstrapped with my own resources. I've had, friends who are angels who have helped, and we've done a small seed with friends of friends, and they quickly, the folks who get it immediately. And we have been very cautious about going out and losing our shirts because our original investors don't want to get diluted too much. So we've been very cautious in finding the right kind of partner for a venture firm for a seed plus, because we're not asking for much money, and we don't really need much money.
Yeah, I mean, I'll try to find the money some other way. That's my advice.
Yeah. Thanks.
Yeah.
Sorry, next question on here.
I think that with regards to what you said before about AI companies, etc., and the need to differentiate, what we saw in the past year was that like a very big paradigm shift. That, like, in a sense, like a lot of the things that we have done would be somewhat a waste to do now, like building our own model instead of like using like off-the-shelf models, and dedicating more resources to the branding, marketing, customer acquisition, etc. So in terms from the perspective of a VC, how much is it, as you said, like about the technical differentiator versus the business differentiator? And can they compensate for one another?
Sorry, could you try to rephrase that in a different way? I don't think I caught the nuance there.
Sure. So previously when when I built like AI product, etc., then it was worth investing in custom technology because it really provided a differentiator. What we have seen over the past several years is that enough hardware can actually overcome a lot of custom wisdom and techniques. The new models are not always like more sophisticated; they are just like so much bigger that like they do achieve a lot of the capabilities that we previously developed in-house. In that sense, it means that, like I might work a month on building like a model, I don't know, like 10 more GPUs might actually achieve the same results in a brute force manner. So when we build the business, we need to allocate resources between the technical work versus the marketing, sales, branding, etc. How much do VCs value these things in the face of, like model scaling that can catch up to whatever technical advantage we build?
Yeah, I think I understand the question. I think that the jury is really out on AI and how fast it's going to advance. I don't think that anybody has a crystal ball. I think VCs in general are very wary of, obviously there's money going into the space, but at the same time, there's a lot of like thoughtfulness where it's like, if you invest, the extinction, my prediction is like the extinction level of all these AI startups is going to be pretty fast and furious. Because if things are changing so fast right now. It's actually very interesting. Like I've actually on an aside, I find it like so ironic how much money was going into the software world in 2021 when there was actually no interesting innovations other than maybe blockchain. And now there's some like serious innovations going on that are like generational, and the amount of funding available is very low. It's really quite ironic. But at the same time, I think things are moving so fast, and it's like it doesn't cost a lot to like build on top of these models. And so I think a lot of people are just like holding their breath and trying to understand like how these things play out reasonably. And also just trying to understand, like, back to, what I've been harping on the entire time is back to customer value. Like, how much value do these AI models really produce? Frankly, I've seen tremendous value. As somebody who's a non-programmer, like I know enough programming to, understand it, but like I can go program stuff in a language now because of AI. Like that's pretty impressive. My kids are probably going to be able to learn programming so much easier because they can just ask AI how to do a thing, right? And it's going to be like way quicker learning curve. However, if I'm using AI to write a blog post, that's going to be garbage. It's literally just filler text. It's like, it's enough where it seems intelligent and like sentient, but it's not at all. It's just like a blurry average of like a bunch of data that the model can access. So, I mean, I just think there's a lot of like misunderstanding, confusion, speed of, change. I think it's just a really tough, we've looked at over 75 AI companies. And I put them into two buckets. Like on the B2B front, there's companies that are trying to be like a co-pilot essentially, right? Like, so you could take any function in the business world. You could have a CFO co-pilot, a sales co-pilot. How many sales AI tools I've seen in the past 2 months, like if I had a nickel for each one, it's incredible because it's so easy to build upon it. Like it's not, none of this stuff is that innovative. Like the innovative part was the large language model. And then I see like low-hanging fruit opportunities, right? And those are the ones I'm more interested in investing in. So it's opportunities where the founding team has some sort of data advantage or some way to get a data advantage to solve a particular problem, like using AI. Like those are more interesting to me. I think that, I'm not sure if this answers your question at all, but I generally just feel like it's moving really fast and people have very divergent opinions, and it's a challenge. I mean, I think at the end of the day, I just go back to like, what problem are you solving for your customer? Yeah. How much are you delighting them? And if AI helps you do that, great.
Yeah, makes sense.
Oh, we have a very late cover, and I wanted to give him the opportunity to introduce himself. Steve? Steve.
Sorry. Yes, I was engaged in a sort of, got one of these emergency calls. I'm sure we're all used to it at this point. My name is Steve Schreiber. I'm a freelance business operations consultant. I actually have 35 years. I was employed. I mean, I'm looking around the room here. Maybe Bonnie. Okay, maybe somebody else also remembers a company called Nextel. I was employee number 100 at Nextel. So Nextel was a roll-up of about 250 to 300 specialized mobile radio, and then ultimately larger wireless communications companies. And that was kind of, it's not the only company I work for, but I spent 5 years there. And that's sort of one of those things that when I talk to people like Michael, or I interface with people like Michael, I am very much excited by the fact that there are people who are interested in investing in SMBs and startups, because Nextel was really just sort of one of those put together roll-ups. You don't see roll-ups very much these days, at least I don't, which is kind of companies building through acquisition. And they start generically, which is great if you have a great idea and a vision, and you can attract investors. Otherwise, Nextel, to this day, there were times when a book was never written. Jack Markell, who's our current ambassador to the OECD and was governor of Delaware, was also the guy who came up with the name Nextel, and was a corporate finance guy for the company. And he was going to write a book about it, for, or at least there's probably a Harvard business case. He was going to write a book. Anyway, I don't want to get on. I appreciate the time. I do business operations consulting for SMB service companies.
Thank you. You have a question?
No, not at this time. Thank you.
Okay.
Bonnie, I'd like to jump in on
Okay, go ahead.
something Michael said earlier. So first, when you were talking to Tom, you ended with what was going through my mind. You said earlier, what's the painkiller, right? Like all these AI tools are just tons of plugins and extensions out there. But you've also mentioned throughout the conversation a number of times about going to market. And so I just want to touch on the speed. Like, how important is that in your book? First to market. I know everyone wants to be first to market, but where do you see that in your decision-making process?
How important is first to market or going to market motions?
Yeah, when you're looking at a business, like, if they're first to market, or how fast they're going to get to market, based on the team, based on the three things you talked about, the team, the fit, the founder, like, do they have that roadmap?
Yeah, to be honest, Joseph, I don't think I have a strong opinion on first to market. Maybe I will in a few years. It's not something that I think about or care about. I mean, I just think like the history of the world is pretty clear that being first to market doesn't equal success at all. So, I mean, I think you can kind of end it there, but at the same time, like, is there a competitive advantage for being first to market? Probably also, it depends on how fast you can run. So if you have product market fit and you're first to market, you can run pretty fast. And maybe that's more important today than it used to be in the past.
Well, yeah, I've been around a lot of people who's like, oh, we got to be first to market, right? They want to control the market. They want to be the first to market, beat everyone. But I agree, like, there's plenty of case studies out there of companies that were first to market and are no longer around, and the second or third to market, took the wind that they built.
Yeah, absolutely. Like I said, it's definitely not on my checklist as like, are you first to market? Are you not? And that would be a part of our investment criteria. But it is a way to create a moat, at least in the short term.
I have a funny little story about that. Back in the VCR days, there was, VCR, and there were the Betamax, as you recall, remember? Or maybe and Betamax was a much better technology.
I remember VCRs, not Betamaxes.
Right, Betamax was first, and it was a much better technology, much clearer, much better. Do you know why VCR won? Because Betamax was used to allow porn. Absolutely true. That's why VCR won that war.
That's interesting.
Yep. So
I would have thought
learn something.
They allowed porn, is what you said?
Yes.
I would have thought that would have helped them win, right?
Yes.
oldest business in the world.
Yep.
Isn't that how the internet got started?
Yes.
Yes, it is. a lot of innovation, it comes from the porn industry. In fact, when Comdex used to take place, and biggest tech conference in the world in Vegas, they always had what they called adultex at the same time. Because if you wanted to see what the real technology that was next, it wasn't at Comdex, it was at adultex, which was porn, all porn. Anyway,
And the sources of innovation have been the space program, DARPA, and porn.
Bonnie, that's
Really?
a great way
expediting
to. Oh, sorry, go ahead, John.
No, just in terms of expediting tech innovation. Those are the driving forces.
Yep.
It's a great way to bring this call to an end, huh?
Sorry, I didn't mean to change the whole tenor of the call, Michael. I just thought it was funny. See, content can be king and can be the winner. Not endorsing porn at all.
Yeah, so Michael, how many of your investments are in the porn industry? Because that's where the innovation is coming from.
Well, now I have another area to search in.
We have time for one more question if someone has one. You look like you do, John.
Oh, I've got lots of questions. I don't want to belabor it with things that might be interesting to anybody else.
But if you want to answer,
I have a quick question. This may have been covered before, so I apologize. But are you seeing, Michael? Are you seeing competition, or what's the level of competition for what you would consider to be ideal S&B opportunities? In other words, when you see something and you are interested in making an investment, do you find out pretty quick that you're not the only one who saw that opportunity, and is there a level of competition, and how do you distinguish yourself if in fact there is competition out there for ideal S&Bs? I'm not talking about the plain vanilla ones that cross your desk every day.
When you talk about SMBs, do you mean like startups solving problems for SMBs?
Startup solving problems. Yeah. I mean,
Yeah.
a good management team, whatever kind of checks the boxes that you would kind of raise to the level of, let's have these, let's kind of look at these guys seriously. Do you now find out, hey, guess what? We're talking to 3 other, private equity VCs, whatever, or not?
Well, I mean, for SMBs in general, like we do invest in startups that solve problems for SMBs. That's not the biggest part of our portfolio. Like mainly our portfolio is companies solving problems for like, mid-sized to large enterprises. But we have recently made an investment, actually an AI company, in the SMB world. How competitive was that to get into? It was competitive. I actually had to beg my way onto the cap table. But the way I got on there is like I said in the earlier parts of the call, which you weren't here for, but we focus a lot on helping our founders go find product market fit faster, and we have some approaches and tooling and data models around that. And we have a lot of satisfied customers. So they were able to, talk to our other founders who put in good words with us, and, they realize it's a no-brainer to have us on the cap table. So, I generally try to position our firm as a way that we can always get into deals. I've actually never not gotten into a deal I wanted to. And it's a big part of my positioning is not being a lead at the seed round, because I'm not fighting to lead the round. I'm just going to be a part of the round, meaning that we can get into the deals that we want to get into. And then we get our ownership up a little bit later in the seed round. So it's kind of it's a pretty novel strategy in the VC world. But in terms of, in general, in the B2B software space, I find it to be extremely inconsistent like today in terms of how competitive rounds are. Either there's like very little interest or a ton of interest, and I'm not sure that either of those extremes are warranted. I think like some of the ones that we think are interesting and there's not a lot of interest, there should be more, and vice versa. Like some of the stuff around AI where there's a ton of interest is probably not warranted either. So I mean, I think I just look at it as, just part of the part of the animal spirits of the game, I guess. You know, it's like,
Are you a
people get
lead,
excited.
are you a lead investor in any of your investments or not?
no, we're always either a follower on a seed round, so like another VC fund sets the terms, or sometimes we invest in like party rounds with other investors, in which case we could be in that case like a de facto lead, where, you know, they're saying, okay, Outbound's investing in this round, but we're not necessarily the biggest check in that round. We could be like a top 1 or 2 or 3 checks in that round.
Right.
Yeah, I mean, eventually, I don't know, someday we might be leads. I don't know. It's not really a topic that matters now, because our fund sizes are what our fund sizes are.
Right. Interesting.
Yeah.
Good.
Mhm.
Our time is up, unless you have parting words of wisdom that you'd like to share, Michael, suggestions. Just
I guess my word of wisdom would be around you know, a focus on finding product market fit. I think is really important for all the founders out there. You know, I think that it's achievable if you have the prerequisites, right? Which is like, you're solving a big problem, you're the right person to do it, you have some technology that's the right technology to solve the problem, and you can assemble the right team. You know, I think it's, you know, I'm an optimist in this space. Like, I think anybody can find product market fit. I think it's kind of tragic how many companies don't. And I think that they don't because they fundamentally have a different like a different point of view. They're thinking about growth before they think about actually delighting their customers. And yeah, so I think that would be the parting words of wisdom is delight your customers before you start trying to figure out how to grow really fast.
absolutely true. And thank you so much. And thank you for being our speaker today. We appreciate it. I don't know if you want
Thank
to
you for
share.
having me.
Oh, of course. I don't know if you want to share your contact information in the chat. It's
Sure.
up to you.
Yeah, absolutely. Here's my email. Mike@outboundcap.com.
Oh, thank you. And thank you, everybody. We'll be back in 2 weeks with an investor. I'm speaking to a friend of mine who I mentor with the Founder Institute, and he's started many companies successfully in the most part, because he might be talking to you about how hard it is to run a company and what you can do about it. And he's got a lot of experience. So thank you so much. Hope to see you all in 2 weeks, and we'll be here in any event. Have a great weekend. And again, thank you, everybody, especially you, Michael. Have a good day, everybody.
Thank you so much.